investing even with limited capital, such as 1, 0, is a frequently asked question. This video addresses the fundamental strategies for beginners to start investing. The content will guide new investors through initial investment steps. The video aims to provide actionable advice for those new to the investment landscape. Investing can appear complex, but it can be simplified into manageable steps. The goal is to build a financial future through smart, proven strategies. This approach focuses on sustainable methods rather than quick, unsustainable gains. The emphasis is on informed decision-making and strategic planning for long-term financial health. A structured investment plan will be provided for a hypothetical sum of 1, 0. The investment plan will offer clear guidance for allocating the 1, 0 across different asset classes. The following plan will provide actionable steps for investing the specified amount. This video aims to equip viewers with a practical strategy for managing their investments. The investment strategy is designed to be easily understood and implemented. The goal is to provide viewers with the knowledge and confidence to begin investing. Defining financial goals is the first step in investment planning. Common financial goals include saving for retirement, a down payment on a house, or other significant purchases. Identifying specific financial goals helps in selecting an appropriate investment approach. Different financial goals require different investment strategies to achieve desired outcomes. Understanding the financial goal is crucial for choosing the right investment approach. Goal setting involves defining specific objectives to achieve desired outcomes. Retirement planning represents a long-term financial goal requiring consistent savings and investment. Saving for a down payment on a house necessitates accumulating a substantial amount of capital. Travel goals require budgeting and planning to explore new destinations and experiences. Effective goal setting provides direction and motivation for achieving personal and financial aspirations. Visualizing goals through text and imagery reinforces commitment and enhances the likelihood of success. Risk tolerance reflects the degree of potential loss an investor is willing to accept for potentially higher returns. A higher risk tolerance indicates comfort with potential losses in exchange for the possibility of greater gains. A conservative approach prioritizes the preservation of capital and minimizes potential losses. Understanding personal risk tolerance is crucial for making informed investment decisions. Risk tolerance assessment helps align investment strategies with individual financial goals and comfort levels. Risk tolerance exists on a spectrum ranging from conservative to aggressive. Conservative risk tolerance prioritizes capital preservation and low volatility. Aggressive risk tolerance seeks high returns, accepting greater potential losses. The spectrum illustrates varying investment strategies based on individual risk appetite. Understanding risk tolerance is crucial for making informed investment decisions. To begin investing, opening a brokerage account is necessary. Numerous online brokers are available, offering diverse services and platforms. Selecting a broker should be based on individual needs and investment goals. Key considerations when choosing a brokerage include low fees and a user-friendly platform. Brokerage websites provide interfaces for managing investments. These platforms allow users to buy and sell stocks, bonds, and other financial instruments. Brokerage accounts facilitate access to various investment opportunities. Popular brokerage websites offer tools for market analysis and portfolio tracking. Diversification is a strategy to reduce risk by allocating investments across various financial instruments, industries, and other categories. Diversification aims to mitigate the risk of large losses if a single investment performs poorly. Spreading investments across different asset classes reduces the impact of any single asset's performance on the overall portfolio. The principle of not putting all eggs in one basket highlights the importance of diversification. Diversification does not guarantee profit or protect against loss in a declining market, but it can help manage risk. Diversification involves allocating investments across various financial instruments to mitigate risk. Asset allocation in a diversified portfolio typically includes stocks, bonds, and other asset classes. Diversifying across different asset classes can reduce the overall volatility of an investment portfolio. The goal of diversification is to balance risk and return by spreading investments across various sectors. Effective diversification requires careful consideration of correlation between different asset classes. Index funds provide a method for diversifying investments. These funds mirror the performance of a specific market index. Exposure to a wide range of companies is achieved through index funds. The S&P 500 is a common market index tracked by index funds. The S&P 500 index represents a broad market indicator of U.S. equities. An index fund is a type of investment fund designed to track the performance of a specific market index. Top holdings within the S&P 500 index include major corporations across various sectors. Index funds offer diversification by investing in a basket of stocks that mirror the index's composition. Tracking the S&P 500 provides exposure to a large segment of the U.S. economy. Exchange-traded funds, ETFs, function similarly to index funds but are traded like individual stocks. ETFs offer a cost-effective method for investing in a diversified portfolio. ETFs combine the diversification benefits of mutual funds with the trading flexibility of stocks. ETFs can track a specific index, sector, commodity, or investment strategy. The trading price of an ETF fluctuates throughout the day based on supply and demand. ETFs provide liquidity, allowing investors to easily buy or sell shares during market hours. Index funds and ETFs both aim to replicate the performance of a specific market index. Index funds are typically purchased or redeemed directly from the fund company at the end of the trading day. ETFs are traded on stock exchanges throughout the day, offering intraday liquidity. ETFs generally have lower expense ratios compared to traditional index funds. ETFs offer greater tax efficiency due to their unique creation and redemption mechanism. When selecting an index fund or ETF, prioritize low expense ratios. Expense ratios are fees charged to manage the fund. Lower expense ratios directly benefit investors by maximizing returns. High expense ratios can significantly erode investment gains over time. Comparing expense ratios is a crucial step in fund selection. Expense ratios for ETFs and index funds are typically found on brokerage websites. Users can search for a specific ETF or index fund by its ticker symbol or name. The fund's profile page displays key information, including the expense ratio. Expense ratios are usually expressed as a percentage of the fund's assets. Lower expense ratios generally indicate a more cost-effective investment. A diversified investment portfolio can be constructed with a limited initial capital of 500 can be allocated to a low-cost S&P 500 ETF, providing exposure to a broad market index. Investing 300 in a bond ETF provides a fixed income component to the portfolio, reducing overall risk. An allocation of 200 to an international stock ETF diversifies the portfolio across global markets. This allocation strategy balances risk and return, suitable for beginner investors with limited capital. A pie chart visually represents the allocation of assets within an example portfolio. The size of each slice in the pie chart corresponds to the proportion of that asset in the portfolio. This allocation provides a snapshot of the portfolio's composition at a specific point in time. Pie charts are effective for illustrating the relative distribution of different categories within a whole. This visual representation simplifies understanding of the portfolio's diversification strategy. Dollar cost averaging involves investing a fixed sum of money at consistent intervals. This strategy is applied regardless of the current market price of the asset. Dollar cost averaging can help reduce investment risk. It also smooths out investment returns over time. By averaging the purchase price, investors may buy more shares when prices are low. Conversely, fewer shares are purchased when prices are high. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of the asset's price. This strategy reduces the risk of investing a large sum at a single, potentially unfavorable price. When prices are low, more shares are purchased. When prices are high, fewer shares are purchased. Over time, dollar cost averaging can lead to a lower average cost per share compared to a lump sum investment. Dollar cost averaging is particularly effective in volatile markets. It does not guarantee profit or protect against loss in declining markets, but it can mitigate risk. Investing is a long-term strategy that requires patience and a strategic outlook. Avoid panic selling during market downturns to prevent losses and maintain investment integrity. Maintaining focus on long-term goals is crucial for successful investment outcomes. Allowing investments to grow over time can maximize returns and build wealth. Long-term investing involves holding assets for an extended period, typically years or decades. This strategy aims to benefit from the power of compounding and long-term market appreciation. Long-term market growth is visualized through historical data, showcasing consistent upward trends despite short-term volatility. Visualizing long-term investment success through consistent market growth. The first step in investing is to define clear financial goals. Understanding one's risk tolerance is crucial before making investment decisions. Opening a brokerage account is necessary to begin trading stocks, bonds, and other assets. Diversifying investments across index funds or ETFs mitigates risk and enhances long-term returns. This video explained basic principles of investing. 1. Viewers are encouraged to engage with the channel for more personal finance guidance. Additional videos will be released covering a variety of personal finance topics. The outro reinforces the value of continuous learning in personal finance.